Good morning. My name is Dan McGeegan. I'm the proud CEO from A1 to welcome you to KŌTO's annual stockholders meeting. My company and I are very excited to showcase to you our company's journey the past 2 years. First on the floor, I want to introduce Michelle Bentley, our Chief Financial Officer.
Thanks, Dan. Over the past 2 years, since my team and I have taken over managing KŌTO Manufacturing, we've achieved great success. David will now explain in depth our income and profit statement.
Hello. As you can see, we did have a slight decline in sales because we failed to foresee the recession and the effects it would have on our business. We did, however, see the effectiveness of lower production costs. We were able to save 9% in that period. Also, our gross margin increased by 2.6%, and in the end, our total income increased by 2.3%. We all know that in order to make money, you got to spend money. We at KŌTO Industries know that better than anyone else. We know competition in our industry is tough and fierce, and we use increased spending in order to get the one-up on our competition. We spent an additional $50,000 on product development in the year 2016, and we also added another $78,000 in advertisement, selling, and market research in 2016 compared to 2015, in an effort to increase our ability to sell more of the product. Also, we made strides to pay off our debt, and in doing so, we were able to save money on income or on interest expenses for each quarter. We did have a small miscalculation leading to a $5,000 fine. However, since then, we have made strides to ensure that all information is checked by at least 3 members of the finance team. Overhead expenses more or less stayed the same, and total expenses increased over time. However, this resulted in an increased total income in the 2-year period. Also, because we had extra cash on hand and an increased profit, we increased dividends in order to give back to our shareholders. Next, I'm going to give some more detailed info on our inventory and lost sales. We had strong sales in the beginning, which led to lost sales when the recession hit and we overproduced, and a recession, which led to a decrease in overall sales, and we were hit with a huge leftover inventory of nearly 6,000 units. However, after careful decisions by the finance team and an increase in advertising spending, we were actually able to sell way more than we predicted and actually ended up with lost sales. And that resulted in us having more profits retained and more cash on hand. As you know, we are in the business of making money, and at a 40% tax rate, that might not sound as easy to some people as it is for us, but no, it's just not as easy. But like they say, a fine is a tax for doing wrong, and a tax is a fine for doing well.
Now I'd like to bring Matt to the podium to talk about our balance sheet.
Thanks, Michelle. Now, if you turn your attention to our balance sheet in the category of assets, you can see that our beginning cash was lower in the second year, but this is due to the extra amount of money we put towards advertising, production, and overall improvements to help us get ahead in our industry. At the end of both years, our final inventory was 0 due to the fact that we underestimated our customer demand, which resulted in lost sales. We attempted to upgrade our company, but consequently, our total current assets decreased from our first year to our second. Moving on to our fixed assets, the cost of our plant and equipment increased by 14.3% in the second year. As shown, our accumulated depreciation increased by 105.3%, which shows that we increased our production capacity to fill orders and meet our customer demand. Even though we had higher depreciation in the second year, the net plant and equipment was higher by 3.6%. Our total assets remained practically the same over the 2 years. We would have preferred to have more impressive numbers, but we spent more to improve the overall quality of our product. The only liability was the loan the other management team took out before they were excused. When we were hired as the new management team for KŌTO, the loan totaled $1.1 million. After our first year, we decreased the loan amount to $950,000 and $675,000 the following year. That's a 38.6% decrease in the loan over the 2 years. We believe that this was a necessary action to pursue because we wanted to lower our interest rate, and as a professional company, we felt that we needed to pay back our debt in order to be held at a higher standard as a company. Our total equity increased by 17.2% over the 2 years. The total equity consists of our common stock, which is 1 million shares, and our retained earnings, which increased by 48.5% due to us increasing our dividends. This concludes our balance sheet report for our first 2 years. Now, if you would please turn your attention to our pie graph, would expense chart 2015-2016. This graph represents where we spent our money expense-wise and to stay ahead in our industry. The largest priority was our overhead expense at 38.99% of our total. This expense is due, sorry, just a numbers guy, I'm not used to this. This expense is due to the amount of production we had by increasing our factory capacity. Our second highest expense went towards our quality and product development with 22%. This expense let us decrease production costs while also increasing our product favorability. Moving on to our selling and market research with 20%, we needed this expense in order to get our product out there and keep knowledge of our competitors. Next would be our depreciation cost, which totaled 13%. This expense shows the increase we had in our production. At 4% was warehousing, which describes our inventory storage. And with 2% we had interest expense, which is loan payments. And with almost 0% we had other expenses, which is due to a fine, which we learned greatly from. Thank you, and I'd like to turn it back over to Michelle.
To ensure that our company ran smoothly, we did in fact have enough money on hand at the beginning of the 2015 year. Due to successful sales, advertising, and quality management research, our team did not have to take out a loan. In addition, the income received allowed us to continue to expand our manufacturing plant capacity. While we mainly manufactured our plant at above 85% capacity, it was difficult to do so when the economy crashed. Our customers were suddenly very wary of spending money on non-essential products. This resulted in a decline of sales. Unfortunately, we underestimated the recession and overproduced our coats, which led to a lot of inventory left over. We learned quickly that during recessions, production needs to be dropped. And that's exactly what we did. Our team cut production in order to have less inventory to keep up with lower customer demands. Other circumstances that affected our revenue was the foreign affairs. Events such as worker strikes, Greece flirting with the fall, and an oil embargo increasing production costs all made running this business more difficult. Our team learned to raise prices when the economy was high and lower when the economy was low. Towards the end of the year, our team managed to get our inventory under control and overproduce so as not to lose sales. Fortunately, inflation was not a major threat during these 2 years, so we didn't really have to deal with any of that. Finally, we decided on hiring 3 salespeople to make up for a low advertising budget. However, we learned that in order to stay in the competition, we needed to keep up with our competitors' advertising. We also kept our product development high so that our product perception was the best. My team and I decided that all 4 research reports were not necessary. So instead, we bought the first 3 and the 4th one every other quarter. We understand that every dime we spend is money you invested. Therefore, we at KŌTO will not spend mindless random money. In regards to our stock strategy, as Matt mentioned earlier, we have 1 million shares of common stock. Since our stockholders are an important aspect to our company, we decided to keep raising the dividends so that our stockholders can share in the wealth as well. On average, our stock price is at $42, with an all-time high at $51 and a low of $16. On average, our earnings per share were $2, which soon increased when we increased our dividends. I'd like to point out our graph here. This is our stock prices. You can see in the 3rd quarter of the first year, our stock price dips a little bit. This is when we hit our first recession. Eventually, it increases and then drops dramatically once again. And this is when we were overproducing and messing up. We underestimated the recovery of our market. I'd now like to bring our CEO back to talk about the future of our company.
Now, don't fall asleep yet, we're almost done. For the future of KŌTO, we've noticed the economy coming back stronger than ever. Using this opportunity, we thought it would be appropriate to raise the price because we believe our customer base is ready. Then with the increased customer demand comes increased revenue, which allows us to raise our dividends to allow our stockholders to be happier. We would also like to take out a new loan to invest in a new manufacturing plant because our current plant will not have the capacity to keep up with our future customer demands. We will lastly then hire another salesperson to cover more area because we want to increase the amount of sales coming in, so they're going to have to soak up more customer base. This concludes our stockholders presentation. I'd like to show that.
To help our RONA, we decided that if we raise our advertising, RONA's return on net assets. So the more assets we have, the higher our RONA will be. So if we increase our advertising to bring in more sales, the higher our cash inflow will be. Also, if we raise the product development, it'll lower our cost per unit price, which will also have a higher profit, so higher cash inflow. And finally, if we raise our price, we'll have more profit as well.
Any strategy going forward have any equipment inventory leftovers and all sales?
Yes, this was included, as Dan said earlier, when we would take out a new loan to have a new production plan. Our current plan is not able to keep up with the customer demand in this high-end market. So if we manage to get another plant, that's what we would do. We would produce more so we could have twice as much inventory and hopefully decrease our lost sales.
Very good. Thank you very much.
Thank you very much.